Hello, Matthew Bell with insuranceprescription.com. Today I want to talk about using life insurance policy proceeds for long-term care funding. So in a previous video, I have talked about different strategies for paying for long-term care. And essentially, this is going to be three. There's really only three ways to pay. Number one, you can private pay. That is, pay out of your own assets and income. That's the first way. Way number two, you pay out of your own assets and income until you spend the money down. It's called a Medicaid spend down, and you qualify for government aid. Way number three, you use the proceeds from a long-term care insurance policy. That's really it. Those are the three ways. Now, there are certain niceties to each of these. For example, long-term care policies can have different features to them. They can be constructed in different ways. They can have different options. They might apply over different benefit periods. They might have different elimination periods. You might have the ability to pay for home modifications in some contracts. Some contracts might apply to nursing homes only. Some contracts might apply to a wide variety of care environments. You're going to have to read the policy fine print, and I get into some of this in other videos, and I will get into more of it in future videos. Medicaid also has complexity. It is a very complicated system, and it's administered by the states, so there are a number of variations to how that's applied. And I may start to tackle that in some future installments as well. But even private pay is going to have some nuance and some variation. So in private pay scenarios, this is where we're going to be talking about Medicaid trusts, other ways of moving the assets around to try to prevent them from being spent down. There are going to be different saving strategies that can be discussed. When we think about life insurance and how it fits into the picture, it's going to fit in the private pay sort of bucket. It's one of the strategies you can invoke when you're trying to private pay. Really, there's going to be four ways of using life insurance. In this series, am going to talk about three of those ways. The way that you can use life insurance that I'm not going to discuss presently is as a savings vehicle. You can use cash value life insurance like you were using a CD, a certificate of deposit. You can just use it as a savings vehicle. I'm not going to discuss that here because that's the use of a policy's cash value. So if it's a cash value policy, that is the use of the cash value. What I want to discuss in this series is the use of the death benefit. So there are three ways to use a policy's death benefit for the purpose of paying long-term care. The first way is what I'm going to call proactive, the before way. And this way, you are going to have access to the death benefit before you die, and you're going to use a portion of that to pay for your care. That's the topic of this video. Now, usually that's going to be accomplished with some kind of a rider, and we're going to discuss it. Way number two is going to be the reactive way, using the proceeds after you die. In the usual way, you die, the life policy pays out, but instead of just using it to pay funeral expenses or to replace income, you're going to use the policy proceeds to repay the family for the money they spent on their long-term care. I'm going to get into that in the second video. The third way, this is something that I'm going to call no net cost long-term care. It's a cool idea that I ran across, and I thought I would just share it. It is not for everybody. It really depends on the stars aligning in the correct way. Let's put it that way. It's got to be a certain spectrum of assets in place, and they have to be available for use in certain ways. It's not going to apply to everybody. Certain people aren't going to be healthy enough for some of these ideas. This is just for general informational or entertainment purposes. Nothing I say is going to be specific advice. It shouldn't be construed that way. These are research leads. So in this video, the use of riders. First of all, what is a rider? A rider is some kind of a policy extra. Think about buying a car. You buy a car and there's a base model, and then you can add different option packages. So you can get leather seats and heating and cooling and cruise control and power locks, and nowadays I guess you can get the ability of the car to drive itself and all kinds of things. So you customize the car for your needs, for your desires. That's what a rider is for an insurance policy. It's a way for you to customize the policy. There are all kinds of different riders. Among the riders are going to be chronic illness riders, long-term care riders, riders that are going to cover you in a nursing home scenario or in some other kind of a long-term care scenario. Now, in theory, there's a couple of different ways that this can go. So, for example, you could have a life policy with a death payment, and then you can also have a rider that provides for a quite separate long-term care payout in the event that it's necessary. But most often, they're combined. And the way they're combined is essentially this, is that if you need the long-term care payout, it's going to tend to subtract from the amount that is available on the death proceeds side of things. Does it always work like that? No, you have to read the contract, but many of those riders allow for you to access the death benefit in advance of the death of the insured, and we call that an accelerated death benefit rider. Whatever the rider is called, chronic illness, long-term care, generally speaking, this is going to be designed to provide for the insured to have a way to pay for care in some kind of a long-term care environment. Generally speaking, this is going to be an assisted living facility, a nursing home, maybe hospice. There are all kinds of different environments. I have other videos on the various environments that can be used in this context. It could be respite care, it could be adult daycare in some cases. Some policies are nursing home only, some are not. Whether it is going to apply in a home environment, you're going to have to look at the fine points of the policy, you're going to have to look at the contract details, and it's going to depend on the company and depend on the policy. Consult your agent with any questions that you might have and make sure you understand what you're buying before you spend money on a contract. For policies maybe where it isn't covered, if you have cash value in the policy, then you can of course use the cash for whatever you want. I mean, you could use cash in a policy to buy golf clubs or take a vacation, so of course you could use cash available in the policies for home care or any of a number of other uses. A chronic illness is going to be one that afflicts you over a long period of time. And it's generally going to be a condition that's going to result in your being incapacitated or ill for at least 3 months or longer. So in other words, this is in contradistinction to an acute illness that affects you for a period of time and then you get over it. These conditions are going to persist. Now there can be conditions that are chronic that may not land you in a nursing home. And those would be things like asthma, certain cancers, type 2 diabetes. And then there might be conditions that are more serious or at least are of a nature that might very well land you in a care facility depending on the trajectory of the illness. So those might be things like Alzheimer's disease, rheumatoid arthritis, it falls into that category as an autoimmune disorder. You also have type 1 diabetes, which can be much more severe, Parkinson's disease. There are too many to list. And long-term care essentially is going to refer to care received over a long period of time. Now that care can be subdivided into medical care, also called skilled care, and non-medical care, also called unskilled care, non-skilled care, or sometimes it's called custodial care. Medical care is going to be the care that a person receives for things like intravenous fluids, dressing of wounds, medical testing, therapies of various kinds, the administration of pharmaceuticals. Those are going to be medical types of care. Non-medical types of care are going to be things like helping a person to get in and out of bed, helping a person to bathe, feeding a person, and those kinds of things. So when we're talking about long-term care, we're really talking about the unskilled, the custodial types of services, because often health insurance can provide for medical types of services, but on the other hand, Medicare and health insurance both do not cover custodial services. I get more into detail on this in other videos, so I don't want to repeat that here, but it's necessary to have that in place at least to understand what we're talking about when we're talking about long-term care. So the triggers for this are going to be twofold. Physical trigger essentially is you lack 2 out of 6 activities of daily living. That's the first trigger. The activities of daily living are things like bathing yourself, feeding yourself, dressing yourself, getting in and out of bed by yourself, toileting by yourself, and being able to control your bodily functions or maintaining continence. There's also a cognitive trigger, so that would be having some kind of a diminishment of your mental capacities such that you require supervision so that you're not a danger to yourself or to other people. So a long-term care insurance policy is a dedicated policy that kicks in when one of those or both of those triggers are tripped. When we're talking about a long-term care or chronic illness rider, essentially the riders themselves are going to be part of a life insurance policy. They're going to have the same triggers as a dedicated long-term care policy, lacking 2 out of 6 activities of daily living or having some kind of cognitive deficit. Now in this case though, the riders allow for an acceleration of the death benefit. That is to say, they allow for the person who is qualified, a person who's eligible to receive benefits, that person can actually receive a portion of the death proceed in advance of his or her death. I'm not a tax preparer, I can't give tax advice, but a death proceed is usually income tax free to the beneficiary. And so when there's an acceleration of the death benefit, it also is in many cases income tax free to the beneficiary. But once again, For particular cases and specialized tax advice, consult a tax preparer. Now, different companies are going to work differently in this regard. Policies are going to be written in different ways. There's going to be different options. So you're going to have to consult your agent and look at the fine print. But usually a rider of this kind is going to allow for some kind of a percentage of the death benefit to be available in advance. So this could be 50%. It could be 75%, 25%. I mean, it could be a wide variety of numbers. It may be limited to a certain percent per year. So it might be 25% per year of whatever the death benefit is. You should be aware also that there are different ways of funding a policy like this. I'm going to distinguish two. The first is going to be an upfront way of funding, and the second is going to be a back-end way of funding the policy. So on an upfront way of funding the policy, you are essentially going to pay for the rider as you go along. So every time you get a bill, part of that bill is going to go for your basic life insurance coverage, and another part, the rider part, is going to pay for the long-term care rider or the chronic illness rider. So you pay for it as you go along. In the back-end way, number two, there is no additional cost tacked on to each bill for the rider. Instead, you pay for the rider when you exercise it, when you are eligible for it. So a larger chunk of money comes out at that time, but it comes out in one block. Now, there's a couple of pluses and minuses. On the front-end way of funding the policy, one of the positives is that you know what you have. So if you're paying for the rider, you're going to know in advance the amount of benefit that you're going to be able to obtain from that rider should you need it. The main negative, though, is that you're paying for it as you go along. If you don't end up needing the long-term care rider, then all of that money is simply gone. Now, for the back-end way of funding, the main positive for it is you only pay for it if you need it. So you're not paying an extra amount on each bill for the rider. You only have to pay for it in the event that you're eligible for it and that you actually need to use it. But the negative is that you don't know precisely in advance what the benefit amount is going to be. And there's a couple of reasons for that. Part of the reason for that is usually there is going to be a kind of a discount or a diminution, a reduction of your benefit amount, and that's going to constitute you paying for the rider at the time that you need it. So I'm just going to run through a very quick example to give you a sense of how this can work, because it can be somewhat complicated. So consider a policy that has a death proceed of $100,000, and let's suppose that you have a 50% acceleration available to you if you are eligible for long-term care coverage. So you end up needing to go into a nursing home, you lack 2 out of 6 activities of daily living, you're certified by a doctor, and now you can access up to 50% of your death benefit in advance. And so what happens if you have paid for the rider all along, you would just get, let's say, $50,000. But if you are operating on the back-end way of funding, then it's going to come out a little differently. So out of the $100,000 that's available, 50% is open to you, so you are eligible for 50%, and indeed, your death benefit will be reduced by $50,000 if you try and accelerate your entire eligible amount. But let's say that there's a discount factor of 20% that's applied, and this is the amount that the insurance company essentially is going to take from that acceleration in order to pay for the rider. So you pay for it when you need it. So let's say it's 20%. It could be anything, but let's say it's 20%. Well, 20% of $50,000 is $10,000. So essentially what would happen is out of the $100,000 that's there in the policy for the death benefit, you're eligible for a 50% acceleration. So you're eligible for $50,000. They're going to take that full $50,000 off of the $100,000. So now you die after, let's say after the first year, $50,000 is going to be left in the policy to go toward your beneficiaries. But of the $50,000 that you accelerated to yourself, you're actually only going to receive $40,000 on this example, because $10,000 is going to be taken at the time that you need it. It's going to be taken as a discount or a reduction, and that's what's going to pay for the rider. Now, it may not be a flat percent. If it's 10%, it would be $5,000 on my example. It may or may not be a flat percent. It may be a more complicated formula, and it may have to do with how old you are, how long you've paid into the policy, how many more years you had to pay on it before the policy would have been a paid-up policy. There can be some very complex math that goes into it. The point I want to make is that if you pay for the rider a little bit at a time, then you can pretty much hang your hat on the benefit amount. But again, that money is just gone if you end up not needing. On the other hand, if you're not paying a little bit on each bill for that rider, then that money is going to be taken out at the time you apply for the benefit and are approved for it, obviously. But that means that the amount that you actually receive is going to be a little bit less than the full acceleration that you've applied for. I know it's a little bit tricky, but let me step back and just talk about some of the pluses and minuses of this whole approach of using riders. So the first main positive is that life insurance and long-term care insurance both have different underwriting requirements. So the things that kill you might not necessarily cause you to require long-term care. Let's say you try to apply for a long-term care policy and you were not approved, then this can be a nice fallback option, because in a lot of cases the rider gets tacked on at a certain death benefit amount and there isn't additional underwriting. Now, if there is the same underwriting, then you may run into the same problems with a long-term care rider that you would with a long-term care insurance policy. But the way to know for sure is to just submit an application. Talk to an insurance agent if you're interested. But again, one of the positives is that certain people might be approved for this kind of an idea who were not approved for long-term care. But a second reason somebody might favor this approach is because they just simply like life insurance better. And what I mean by that is life insurance is going to pay out because you are going to die, right? It is going to pay out, 100% certain. If the policy is in force and the policy is a permanent policy, which these are generally going to be, then the policy is going to pay out. One way or the other, it's going to pay out. On the other hand, if you are paying for long-term care insurance, even if the probability is high that you might need it, 30%, 50%, 70% chance, depending on the numbers you look at, it's still the case that there is a non-negligible chance that you might not need it. So some people like the idea that life insurance is a guaranteed payout. A couple of negatives. So the first one is that if you do have to have the long-term care rider or the chronic rider pay out, then in some cases it will diminish the amount that's available to the beneficiary. It depends. It depends on how the policy is written, how the rider is constructed, whether or not you are paying for it in advance, whether it's an acceleration of the death benefit, or whether it creates some kind of an ancillary benefit that's available to you. You want to make sure you understand the fine print, but in many cases these kinds of riders are accelerated death benefit riders, which means they will diminish the amount of money that is available to the beneficiary in terms of the death proceed. And the second negative really is that long-term care is expensive. And if your rider is giving you 25%, 50%, or even 75% access to the death benefit, the death benefit's going to have to be pretty big in order for that type of percentage to cover the entire cost of nursing home care. Numbers vary, but the average cost of care in a nursing home might be $80,000, $90,000 or more. So if we're talking close to $100,000 for a year in nursing home care, and let's say you have a 50% acceleration, well then you're going to need at least a $200,000 policy to just get 1 year's worth of funds to cover a nursing home if you're trying to cover it 100%. So there are a number of things to consider, but if you think you might be interested in something like this, I would advise you to simply reach out to an insurance agent and just talk through what your options might be. Ultimately, the probable route will be to simply submit an application to see if you are approvable. But if you found something of interest in the video, please like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I remind you, this is part 1 of a 3-part video, so stay tuned for parts 2 and 3, where I get into a different way of using life insurance for long-term care in part 2. And in part 3, I get into what I'm calling a no-cost long-term care kind of a plan. Thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you.